All right, good morning, everyone. This is Joseph Trevisani for Worldwide Markets. I apologize for the delays. It seems like one of about every 5 webinars, Microsoft is laying in wait for us, basically sandbagging us. It's always fun to blame it on Microsoft. It's probably not their fault. At any rate, today's topic is what are the dollar going to do for the rest of the year? I'd like to say I have really good insight into this, and I know what the dollar is going to do, but in fact, of course, we all know that that's not true. What we can do is look at the potential changes in the trend line, or at least in the what's motivating the markets from here till the end of the year. And I'm going to address that in 1 second, so just bear with me. I just have to do one more thing. Hang on. I have a 15-year chart up here. These charts today, I know they're going to be a little busy, but I'm trying to draw some comparisons between what is motivating the anthropomorphized dollar. This chart we have here is the white line. This is a 15-year chart. It's the Dow. I'm using the Dow sort of as a proxy for world equities. Gold, the DXY, which is sort of a general dollar indicator. The USD euro. Now, what I've done with the non-dollar-based currencies on all these charts is I've given you the inverted level simply because it's easier to follow. And the MXWO, which is the MSCI World Equities Index. So there are two factors I think that motivate in the current world. That have been motivating the dollar. And by the dollar, I mean not just the dollar against the euro, not just the dollar against the yen, not just the dollar against the Canadian dollar, but the dollar in general, which is why I have the DXY up there. However, the DXY is deceptive because the DXY is heavily weighted to what the market trades. We, as freelance, if you will, great term from the Middle Ages, currency traders are free to go wherever we want to trade. One thing that we certainly have noted, if you're looking for movement, if you're looking for percentage, although it's costly overnight, go to the Brazilian real. So the two different trends, the two different ways I'm going to look at the dollar. One is the traditional way. Central bank interest rates, stuff like that. What is the economy of the various countries doing? What rate cycle is pending? And what are we going to do about it? When we look at that currency, now let's get a shorter chart for this. This is 2008 and 2009. And I'm going to tie this. Well, I'll tell you what we're going to do this. Let me just do this one. Okay, this is the Bloomberg Commodities Index, gold, and DXY. I'm going to do this in a second. So let's stick with this one right here. The two ways that I look at the dollar, I think the two sort of paradigms, the two market conceits as to what the dollar is doing are usually separate. One is usually much more prevalent as far as its motivational factor and driving the trends. And that, of course, is the standard one. Central banks, interest rates, economies. The other one is, in a way, I'm going to say there are three actually, but this one is tied together. The second one is one that we see intermittently and saw it very, very dramatically during 2008, 2009, of course, and that is the dollar as scare factor, or as antidote to scare factor, the safe haven status. We haven't seen that recently. We can say right here, this rise in the dollar index right here in 2014 and 2015, in my mind, is far more traditional than it is scare. We're not there yet as far as the fear factor in the markets go, and in fact we are far more inured to catastrophe than we used to be. 2008 and 2009 certainly took care and raised the threshold of pain in the markets for what scares the traders. We've also seen that although the central banks cannot create robust economic growth, all of their tools are inadequate for it, they can certainly stave off collapse. And so that has been proven rather dramatically about 5 years ago, 6 years ago, and it's something that I think people are relying upon right now as far as a backstop to the world goes. So, from where we are now let's take a look at an actual dollar chart. Let me find one here. There we go. Okay, this is what I was looking for. This is the euro. Okay, the euro and the dollar. Since about it's a year chart. Now we all know the dramatic fall in the euro, rise in the dollar from last summer. Summer of 2014, not 2015. This that we've seen this year, although it looks and there is a tremendous amount of volatility, the range is relatively limited. The euro is the most heavily traded currency, the most volume goes through. Although I remember I saw an article yesterday or the day before about how limited liquidity was becoming in the FX markets. It's a very difficult thing to judge because on this side, on the retail side, liquidity is never really an issue. It doesn't seem to me that the moves in the currencies, either with their frequency or their degree, are any greater than they have been in the past. In fact, they're probably less than what I remember from 20 or 25 years ago. However, a relevance from 25 or 25 years ago and something is changeable and has changed as much as the currency markets is probably a very limited utility in making judgments about the liquidity today. But if we look at the euro, we have basically a little more than six-figure range for 5 months. For the past month, September, a little bit more, we have a four-figure range. But what's interesting about the formation here is you are seeing a range trade back and forth, but you are not really seeing that much of a compression of ranges. You could make the argument that this is a compression here because compression of ranges almost inevitably leads to a breakout. So for the past 5 months, we've had a very steady range in the euro. That's true also of the DXY. Notice tights, 5-figure range here. But it's also absolutely no trend. So remember, we have, do I have a yen up here? I did not put a yen up here. But the yen is basically the same thing. That's why I didn't put it up. So for 5 months, since the beginning of the summer, it's only the beginning of the fall now. Oh, wait, I do have a yen. Excuse me. What am I saying here? Okay, same thing in the yen. The yen, we got a little more volatility. We basically have two ranges. We have 126 to 121, 121.50. And then we have this one, which is almost the bottom of that one, 121.75 to 118.26. So the major currencies are doing zip against the dollar. Is that true of the dollar in general? And I think we know the answer to that. That's clearly not true and brings us to the second possible trend line that is affecting currencies and not specifically caused by the dollar or by dollar developments. Let's put it this way. When the dollar rises, let's take a look at this. And what I'm talking about, of course, are commodities and commodity currencies. Let's give an example of it and then talk about some of the background of it. Remember these things. Very little is going on. So there's plenty of day-to-day volatility, which is good for all of us. But as far as trend lines go, we have had zip. Frankly, not just since here, I compressed it to, in the euro, I compressed it to May, but in fact, the trend goes all the way back to the beginning of the year. We could say the same thing that we said in the yen. We have two sets of trends, two sets of ranges, basically. I'm exaggerating. 5 figures from 1.05 to 110 here, and then the other range from here to here from in March and April. And then we have a range from basically 108 to 115, a little bit less in this period here and this period here. No trend. Now, is that true? If you're trading the dollar and you're stuck here, well, you could do a lot of trading, but there is no trend to ride here. Okay. Is that true of the dollar against everything? And I think you know the answer, because I certainly do. This is the same time period in the inverse of the Canadian dollar. Canada is a resource country. And you can see what I'm tracking. That is the Bloomberg Commodities Index. It has a very long run, that's why I used it. And you can see how closely that is tracking the Canadian dollar. Now, this is telling you that for the Canadian dollar, and let's take a look at the Aussie. The Aussie is, guess what? I'm sorry. I didn't put the commodities index on this one. So let's just stick with the Canadian dollar. But you can take a look and you can see the trend, and you can compare it to what's available. What's this? Okay. Here, I made it smaller. So you can see the very great similarity in the trends between the two. And it's basically telling you that they're commodities currencies, which is a statement of fact. So here we have a pretty much straight commodity play for the dollar that is not dependent on and is operating independently of the trend in the dollar or the lack of trend in the dollar in the same time period from here to here, May till the end, May till now, against the majors. Let's take a look at another one. Where's my real here? This is a little more interesting, but it's not dissimilar. This is the inverse of the, and I'm using all the inverses so we have the same comparison. Okay? I want to know the value of the currency, right? Not the value of the dollar against the currency. So for the Canadian here, the reason I put the inverse here is because I want everyone to see what the Canada is doing in a more dramatic fashion. If we put the dollar Canada up here, what happens is as the Canada goes down, the dollar Canada goes up. So you can see it. This is just a better graphic representation. Same thing we have here, but this is the Chinese yuan. And it's interesting, and this shows very dramatically what they have done as far as matching the curves. This is the commodities index, and this is the value of the Chinese yuan. And when they were holding it steady through here, they had been letting the yuan appreciate slightly. But for much of this time, it was very much held in stasis. And then suddenly they did this. We all remember that one. That set off all the turmoil in the markets. And what they did is they brought it down to the graphic representation of the level of the commodities index. Okay, so we see these ones. In Aussie, I showed you already. Let's put up DX. Is this DXY? Yeah, this is DXY. Okay, I showed you that one. Okay, now, this, and I should have put the commodities index on this. This is the Brazilian real. For the Canadian dollar, for the Australian dollar, the Kiwi would show you the same way, the New Zealand dollar. The change in the currency against the dollar, the lowering, the devaluation of the currency, the selling of the currency against the dollar, the buying of the dollar, is almost exclusively a commodity play on the national economy. And it is primarily related to China, not entirely, but for many of these commodities, China is not just the largest consumer of these commodities, especially industrial metals. It is the largest consumer by several factors. So it is a huge, disproportionate effect on commodity pricing and on commodity currencies that depend on mining resources. What's going on in the Brazilian real is compounded. Now, if I remember, Brazil has about a 14% interest rate. I have to know exactly what it is because they've been trying to defend their currency. So if you're looking to make a big killing, you might very well make a big killing in the currency, but you're going to pay for it in the overnight roll because the rates are very, very high. That's sort of a standard traditional way of doing something. Bring us back to the Euro ERM crises back in the late 90s when is that the late 90s? No, the mid 90s, sorry. When European countries were trying to keep their currencies within bands against the dollar, and they failed rather miserably. Central banks have limited ability to do this. They pretend that they do, but I think the world is actually moving beyond, in many ways, the control of the central banks. At any rate, Brazil has other issues. Brazil has political issues. It has political scandals. It's had an extremely unpopular President, Dilma Rousseff. There are noises being made in the country about impeachment, all sorts of other things. So the Brazilian currency, which is a great trend, although a dangerous one, is based on more than the change in the commodities. Okay, so this is the sort of subsidiary trend in the dollar, which doesn't tend to affect the DXY as a representative of the dollar very much, because the DXY is a weighted average. So it's the DXY. Let me see if I can find that chart here. Here, DXY, purple. USD Euro, green. They track each other. That's very obvious. That's just a statement of how the DXY is constructed. So we have two separate trends here in the dollar. And I think as traders, it behooves us to look beyond the majors. Because what is the easiest and most successful thing for a trader to utilize? It's a trend in the market. It's a trend that gives you that added decision making when you're thinking about what to do. When you have a steadily depreciating currency like you have in the Canadian dollar, then the weight of your decision as to when to open, when to close, and what to do is reinforced to a certain degree by that trend. Now, it doesn't help you in the day-to-day decision, but it does give you the bias as to which side of the equation to be on. You're not going to get currency. Now, you did have that in the euro from the summer of 2014. You had it in the yen when Mr. Abe took over. And if there is a, well, let's talk about, I think I'm going to do the next webinar on the Japanese yen, because what's happened there is absolutely fascinating, and it is not, the discussion of it extends well beyond the specifics of the currency markets and even the specifics of interest rates and financial policy and monetary policy of the various central banks, primarily the Japanese central bank. I'll just say in passing that except for the devaluation of the Japanese yen, I can't point to any particular success of Abenomics. The problem with Abenomics as the problem with the Dow that is facing right now. I put up a tweet yesterday. I called it the Dow of Fed. I should have probably called it the Zen of the Fed, or the Fed Zen, because on the same day, you had two diametrically opposed statements from members of the Federal Reserve Board here in the United States. You had William Dudley. Oh, that's fine. I think I will do the yen next time because it's kind of interesting. I always love talking about the Japanese yen because it leads you directly to some of the limits of central bank policy. And when central banks, politicians in general don't like to take responsibility if they can avoid it. They like the glory, but they don't like to make the hard decisions. And what's happened over the past 15 years, under the enigmatic but very powerful personality of Alan Greenspan, who promoted just as brief aside, who promoted the infallibility, the wisdom, the all-knowingness, if you will, the omnipotence of central bankers, was a politician said, great, if you guys are omnipotent, if you guys can do this, if you're in control, we'll give you control. We don't want to have to make tough decisions. And in fact, we don't want to be responsible. So that is an extremely pernicious idea, but it is one which has taken over almost the economic and financial policy of almost every country on the planet that has a central bank. At any rate, let's move away from that. So, in Japan, the only real success of Abenomics has been the devaluation of the Japanese yen. As far as anything else goes, it's judged certainly by me and many others to be a failure. Japanese economy is back in recession. The industrial production numbers, deflation have all returned. The problem with Japan is not the monetary supply. They've been buying. The Japanese government is monetizing about 100% of its debt. Japanese money supply is not rising. When you see these things, you know that there is mathematics would say that the money supply is a second derivative. It's not the primary issue. Okay, but let us go back to this topic right here today. So the commodities index. Let's take a look at some more. Okay, this is the MSI Emerging Markets Index, and we all know this, and the Commodities Index. That's a good. I didn't run a correlation on this because, frankly, my statistical days are long behind me. But you can certainly see the correlation visually on this as to how important it is for the emerging markets currencies. So this is the second, and I think right now, for us, the most important correlation for the dollar and what it is we're looking at. Okay? This is the same thing, but it's much closer in time. This is a 20-year index. This is even more dramatic, I think, as far as what it is that's driving emerging markets. This is the emerging market, the JP Market emerging market index, and the MSCI emerging markets and commodities. One of the issues here that we haven't dealt with, but we're going to have to just touch on it briefly, the commodities index, commodities pricing, it's all market-based. Sounds like a very innocuous statement. No, it isn't. What you see here, look, and I should have run this back a little further, but look here. You have the type of variation. Look before about, say, 2002, right? You could say actually, whoa, my mouse almost died. Okay, What you have here is a variation, which is essentially a reflection of the business cycle. Commodity pricing goes up, commodity pricing goes down. What you have here is something of a different order. And this translates across all commodities. Remember the spike in oil prices, $140, almost $150 a barrel, based on nothing in economics. Here, what else do you have here? Which I don't have on here, but I could show it to you. You have the advent of worldwide low interest rates coming from the Fed, coming at least originating first with the technology crash in 2000, but even more so in the 9/11 attacks. Since then, we have more often than not seen extremely low interest rates and the Fed's reliance on the trickle-down effect of the wealth effect. Well, the wealth effect, by and large, doesn't work. But what else is involved in the wealth effect, which the Fed prefers to ignore, and other central banks as well? That low interest rates and excessive cash don't only affect the equities, which are supposed to have an economic wealth effect, make everybody feel wealthier, they buy more stuff. It also affects all of the trading markets. This is a direct result, in my view, of the excessively low interest rates throughout that period. And you could say that's true as here as well, but not the only one. What do high commodity prices produce? Excess returns for those who can capitalize on them and sell their products at those artificially high rates, or at least those artificially market rates. Meaning rates not delivered, prices not delivered by economic need, economic demand, but by exaggerated participation in pricing markets. Now, also through this period, there's a fantastic reliance, and this is emotional, and this is standard, on the ability of China. I'm watching, I think, a Netflix show, not a promotion here, but why not? Marco Polo. It's pretty good. But one thing that it does illustrate, it is the utter fascination, not just in the West, for China as a market and China as a culture, and the size and diversity and accomplishments of the culture, but also true in Asia as well. It's depicting, it's about the Mongol dynasty in China in the 13th century, and its view both of China and the Chinese view of the Mongols. So again, there is this fascination with the ability of China to work outside, if you will, because it's more accomplished, which is largely not true, economically than other countries. And you had some of that through here as well. But the primary result, I'm going to get to that in a minute because we have to move. I'm going to go move on to the dollar about that. I'll answer that. Oh, by the way, I forgot to do my usual. Anybody who has any questions, comments, considerations, jokes, anything you'd like to do, just type them in. I'll answer them as best I can, and I'll stop for it. I much prefer to have a discussion here back and forth, even though your voices are typed rather than audio. I think we all have much more fun when we do it that way. So one of the primary results of, and we're seeing right now, and it's one of the problems for all of the central banks right now, all these low interest rates have created enormous malinvestment, resource overproduction. I just read this before I came into the webinar, that the Chinese are firing up a new steel blast furnace that has brand new, that has greater capacity than any existing steel producing complex in the West and probably in the world, but it didn't say that. It did say in the West. This is coming online now, yesterday, at a time when commodity prices are crashing. There is enormous overproduction on the resource side and on the manufacturing side. Everyone, and we've discussed this before, everyone is chasing the same consumer. We're in a global market. The U.S. is not going to escape this. I'll talk about that in a second. So this commodity boom, which also took up the stock markets of all of the emerging markets. You also had through that period and through some of this period here low interest rates in the United States, driving the demand, the search for return. All of this drove to the emerging markets. On the currency side, on the equity side, if you will, on the currency side. But of course, they're really very similar, because if you're buying into the Brazilian stock market, you need to do it in real, and so you're going to drive up the value of the real. Much of that is reversing right now. Okay, let's take another look here. I'm going to bring up I want to just do the currency one, then I'll talk about your question here. This is even a greater correlation here. This is the Bloomberg Commodities Index and the J.P. Morgan Emerging Markets Currency Index. That's a beautiful set of correlations, isn't it? If you're looking, again, as I said before, for a trend, this year, the trend has not been in the majors. The trend has been in the emerging markets, and it's based on this. It's based on the change in the commodities index. Okay, this unfortunately the Morgan Commodities Index only goes back to, FX Index only goes back to 2015 years. But you can see exactly the correlation here, especially through the collapse in 2008. Basically walking the plank over here, lead weights all the way down, and then back up again. Okay, let me ask you the question here. I'm just looking for the 20-year commodity chart. I know I have it here somewhere. Here we go. Let's do this one. Okay, this is the 20-year commodity chart. Okay. The question is when this commodity weakness will end. The problem I'm seeing right now is that you have this dramatic collapse. It's now going on for 3 years, from 2011. And it's based on a slowdown, primarily a slowdown in demand from China. But the Chinese economy is opaque, which means two things. One, that it's very easy for doomsayers to look at anecdotal evidence and say, if you think it's bad so far, it's going to get a lot worse because there's all this overcapacity. What the Chinese have primarily been doing is spending and building things that don't have a great deal of economic validity. The steel plant that I mentioned. I've been to China in 2 years. I'm dying to go back. And this time I'm dying to go outside of Beijing or Shanghai and spend some time traveling around the country, which I haven't done in almost 20 years. But these types of anecdotal analysis is not particularly useful. It makes for great stories, it makes for great journalism, but it doesn't make for good analysis. So that's the problem. You get speculation both On the corporate side, meaning the people whose business is to promote stocks, as most analysts and others are, and I don't mean this entirely facetiously. And for them, China will recover. For the doomsayers, China is headed towards collapse. I don't think that it is. But I think that things are both much worse in China than is let on. And where do you get notions like this? Where do I get notions like this? Beijing and the Beijing government is a function of centralized control. It still is. And when they do things, such as a surprise devaluation of the yuan and then attempt to reverse it, when they say that they're going to support the stock market and then they fail at it, when they threaten short sellers, many of the things that have been happening leads me to believe that they are far more concerned about the hollowness of the Chinese economy. Remember, that steel plant that went online yesterday, its usefulness, unless it can sell its steel at a profit, or at least sell its steel, then its usefulness to the Chinese economy is almost over. Because that project cost a lot of money. The Chinese government must have spent it. It supplied jobs. It supplied housing. It supplied economic growth for the Chinese economy. But unless it can sell its steel, or the Chinese are willing to simply build it and stockpile it, make it and stockpile it, its usefulness dropped dramatically the day it opened. So the pressure to keep the Chinese economy rolling, if there is this vast overproduction capacity, both in China and in the world, becomes ever more acute. The only thing you can do is build more stuff. Well, that stuff compounds the problem. Because one of the things you'll do is you'll build more plants, which won't have any buyers for their products. So when you look at the commodity weakness, which is the question here, it seems to me that there is a good deal more that it can go. Now, the best analysis I would look at this is to say this. This is the range of commodity pricing that we have going back 20 years. We are entering well into that category as far as the bottom range of the pricing goes. So, if that's true, then for the commodities, you would say, well, we're getting into the range where they'll be a bottoming because it will revert to the business cycle. The problem with that is that the productive capacity in resources back here is dwarfed, although I don't have a figure, by the productive capacity here. And that productive capacity either has to be shuttered or it drives prices down. It's a lot like the shale oil producers here in the United States. The largest amount of economic capital is already spent. It's sunk costs. Now, that's not entirely true of shale oil because shale oil has high operating expenses. But regardless, when you open a mine or you open a resource processing plant, the largest amount of expenditure is upfront. So although it may not be economic, meaning you may not make a profit, in order to stay in business, you produce and do what you can to pay the charges on your loans, on the money that you borrowed to build the plant. Because as long as you can keep those loans active and keep some people on the payroll and continue to produce, you're still in business. Once you stop, the whole thing has to get written off. So the pressure for resource producers, for manufacturers, for factories, steel plant operators, once you're up and running, is to continue to produce even if it's no longer an economic proposition. So all of those pressures are pressures that will depress commodity prices further. It seems to me that the gathering forces in the world economy are still overproduction and deflation. Both the United States, Europe, and Japan are proof, positive if you will, that monetary policy alone, this, peace for Milton Friedman, is not entirely and solely, or inflation is not entirely and solely a monetary phenomenon. We have seen the ECB, the Bank of Japan, and the Federal Reserve fail almost utterly to create inflation by simply printing money. There are clearly other factors here. Okay, so back to the dollar. So I think we are in for another bout of commodity price weaknesses. I don't think it's going to be as dramatic as this. On the other hand, remember, markets tend to get ahead of themselves. They tend to panic. They tend to get worried, and they sure as shooting tend to overshoot. So I think we're in for more commodity weakness, because I think what you're going to see is more bad statistics, more out of China. And that, more than anything else, is driving what we're seeing in world markets right now. For the United States, the question is, are we decoupled? Oh, of course we're not decoupled. I mean, this is the silliest idea. I don't know why it keeps coming back, but it keeps coming back. Nobody is decoupled from anybody anymore. The Europeans were not decoupled in 2008, despite what Mr. Trichet and others on the governing council may have thought. The United States is not decoupled from the world. The U.S. will not prosper. Although, relatively speaking, it might be better off. There were countries in the world in the Depression who were far better off than the United States. But no one is decoupled. And any economic idea or policy which depends on that is very foolish. Okay, so back to the dollar. I'd like to ask FX Street if we have how much time we have here. Could somebody just type into the chat so I'll know? So back to the dollar, okay? We have, I think, three potential scenarios running forward till the end of the year. One, I've showed you, is based on the commodity currencies against the dollar. And historically, except for the real, there's plenty of room for those to continue to move. The Aussie could go a good deal lower. The dollar Canada could go higher. The Canadian dollar could go lower. That's true of the Kiwi and many of the other resource commodities. I think that is probably the most likely scenario. Okay, thank you very much. I appreciate that. So we have another 10 more minutes. So let's take a look at one or two of those. Now, I don't have the historicals up on these things, but let's take a look at the Aussie. But I have enough memory to know that the Aussie could easily go down to 0.5, I believe, which is where it was back in the early 90s, based on simply the change in potential commodity pricing, because what I've said, the forces coming to play are not the normal, historical, cyclical business cycle forces that we have seen in previous eras. This unprecedented run of low interest rates for the past 15 years, and I know others will calculate this back much further, but I'm just going to go back to 2000 with the U.S. low interest rates prompted from Alan Greenspan by the 9/11 attacks here in New York. You know, those, no, I'm not going to go down that one. That's a little too controversial for that. That era where the Fed and the other central banks have used interest rates to essentially replace all sorts of other more necessary, more effective, more historical, and more beneficial policies out of the government, or even laissez-faire, just leave it alone, has a cost and will have a cost that I think is coming due. It's very difficult to look at this commodity, where's my 20-year boom, and not be concerned. Yes, the Chinese economy grew dramatically during those years. It appears to be growth that was inordinately unbalanced. But even the Chinese economic miracle, if you will, don't forget, there have been prior economic miracles. So these came from war, obviously, Germany and Japan after the Second World War. I remember when I was in grad school and undergraduate school in the 80s, how, yes, 30 years ago, yeah. Anyway, how Japan was set to take over the world, and how supposedly the land under the imperial palace in Tokyo was worth more than the entire island of Manhattan or some other stuff like that. And of course, it was complete nonsense. It's exactly the same issue. It is market pricing that has no reality. We have some of that here as well. So for the commodity currencies, I think the trend remains intact. At the very least, I would expect that this commodity index goes, which is probably about 300, goes down to here, which is about 250 or so, maybe 220. And in fact, I think that no, and I'll answer that in a second. I do think that there is more to run on the commodities. Now, to the central bank pricing of dollar. And of course, here we're talking about interest rates. One of the drivers of this fall, not the only one, of course, commodities are largely priced in dollars, actually exclusively placed in dollars. I don't think the yuan or the Russian attempt to have oil or other things priced in dollars have gone anywhere. Has a dollar component, of course, but it's not the primary driver of commodity pricing. Yes, as the dollar rises, it changes the terms of trade for dollar price commodities. But if you look at the range of the commodity index here, it's at 1,300, and here it's no, sorry. Sorry. Here it's at 240, reading the wrong scale. Here it's at 240, and here it's down at 87. That is far greater. That's a threefold change, basically, 300%. That is far greater than the type of percentage moves you get in currencies. So this is not primarily a currency move. It has its aspect to it. It often acts as a catalyst. But that's not the primary reason for the change in the commodity pricing here. So for the as I said, for the commodities. Now, to the second part, I'll answer the China and Japan in a second. And the answer to that short is no, I don't think that'll be the same. But let me talk with. I'll talk about that in a minute. The central bank issue for the majors is, I think, largely priced in. Whether the Fed raises rates in September, whether it should have raised rates a year ago, whether it raises them in October or December, this is one of the more perverse discussions I've ever heard in international economics. We are talking about a quarter-point raise. Its economic effect is nil. It only matters if the Fed is starting a rate hike cycle. And guess what the Fed is not starting? They can barely bring themselves for a quarter. I was amazed watching I know I keep jumping around, the stock market reaction is down 300 points. You had the Dow, the Zen of Fed. You had Dudley saying we can still raise rates. Dudley, the ex-Dove, apparently. We can raise rates maybe in October. It's still in play. Okay, cool. And we had Charles Evans out of the Atlanta Fed saying it's a bad time to raise rates. We should prolong it. Does the Fed forget that markets dislike indecision? They don't like not knowing what's going on. And probably the most damaging thing the Fed can admit to, which it is admitting to, is it doesn't know what to do. And the Fed doesn't know what to do. A quarter point is going to make zero difference. So, back to the dollar and the Fed. For the majors, which is where this primarily plays out, because the interest rate effect for the emerging markets is trumped by the effect of their aspect of being commodity currencies. That's far more important to them and to the value of their currency than the competing interest rates vis-a-vis the other central banks, such as the United States, which, say, the Aussie or the Kiwi is traded against. So for those, for the commodity currencies, the dominant effect, the dominant impact is from commodity pricing. For the developed economies, say Japan, the United States, Europe, the EMU, the European currency, Swiss, the UK, the impact of central bank rate policy is far more important. And for those, we are not going to get a great deal of change. So I don't see that and I know I'm just extrapolating from current trends, but unless something happens and suddenly the Fed, I don't know what can happen, frankly, to change the Fed's indecision, you're not going to get a rate hike cycle anywhere. The Fed appears to be terrified of raising rates. You want to scare the markets, then be terrified. Not know what's going on, not have a policy, not be confident, and worse, not be right. People notice. The Fed has been saying that inflation is going to move back to its target in the medium term. Well, they've been saying that for like 2 years, and it hasn't done anything. That means their policy doesn't work, and their policy doesn't work. So, for the majors, I don't see, until there is some further development, I don't see a trend developing based on interest rates. The U.S. is not going to go into a rate hike cycle. The Europeans have already done as much as they can. They may do more QE, but it's been remarkably ineffective. QE is an extremely diminishing return policy, and I think even as a diminishing return in the currency markets. The one thing that might have a dramatic effect if suddenly in a few, 2 weeks or a few months, the Fed turns around and says after they raise rates. Remember the last time there was a rate increase from a central banker that thought that it was decoupled. Summer of 2008, ECB raises rates. I think it was a quarter point right before the collapse. They too were saying that the European Union was decoupled from the rest of the world as far as its banking system goes. Complete nonsense. I've told that story before. I won't tell it again about hearing from people downtown when Trichet came out and said, I'll tell you the story. Some of you have heard, I'm sure. I know a lot of people downtown. I worked on Wall Street for many years. My wife's involved in Wall Street. And was anyway. And one of the things that she was involved in, anyway, I knew a lot of people in the asset-backed market. And Mr. Trichet, I was meeting somebody for drinks or dinner or something downtown. And Mr. Trichet had just come out and said, we don't have any banking problems with the asset-backed securities in Europe. Our banking system's good and solid, so I'm going to raise rates, and we're decoupled, and everything's hunky-dory on this side of the Atlantic. And I would tell friends of mine this from the asset-backed markets, there's the markets in downtown, and they look at me like I was nuts. I said, it's not me, it's Jean-Claude Trichet. And they said, what are they talking about? Or they probably said, what are we talking about? No, I didn't do a New York accent. The Americans who originated these asset-backed loans based on the U.S. housing market had sold billions upon billions of this paper to the European banks. They're chock full, stuffed with this stuff. So it always was amazing to me that Mr. Trichet could say something like that. So whenever someone tells you, or you read that it's because this particular economic entity is decoupled from the world to a great degree, do not buy it. Okay. Dude, China will be like Japan. No, I don't think so. I think Japan's primary problem is demographic. There are great structural impediments, apparently, within Japanese culture and Japanese politics. But it seems to me that the inertia displayed by Japanese economic policy over the past 20 years is because, and I'm going to go grand on this one, there is a lack of demand for change in benefits from a rising younger generation. But again, I've not been to Japan, so I don't know. Okay, so let me just wrap up here with the currencies. So I am not seeing now the one thing that could happen here, as far as the majors go, and this is the last issue here as far as the dollar goes, and that's the safe haven trade. We have not seen the safe haven trade in the dollar. We've seen it a bit in Asia, where leaving China, hot money leaving China, ends up in the Japanese yen, not because the Japanese yen, the Japanese economy is doing so well, but it's a safer play than the yuan, which has capital controls and all sorts of other stuff. Okay, so this is the last issue. Is it possible that we will resurrect, here's the DXY, okay, right here. You can't see it so well, but right through here. This is the world index. This is the index. So this is what we're talking about right here. Let me see if I have a better one. Here it is. That's 2000, here we go, 2008 and 2009. Okay? This is DXY with the gold and commodities. Okay? I don't like that one. Let's do this one. Here, this is the one I want. Okay, this is the one I want. Sorry. The last issue. Is there a possibility for a safe haven trade resurrection vis-a-vis the dollar? The fear trade, the Japanese trade, money coming out of China and going into Japan, is not primarily a fear trade. You could say it's a safe haven trade, but it's not one because you feel the world is collapsing and you think Japan will survive. Japan probably will. That trade plays primarily to the United States, or at least it has in the past. It certainly did in the fall of 2008, which is what we're talking about right here. Will this trade be resurrected? Will this trade be resurrected? That's rather hard to say, of course, But one thing that is true, if things become dicier, and I think the Fed's indecision, and I'm frankly very amazed that they're willing to put this on display, but they have, over this minuscule rate hike. I'm not sure that they understand, their policy of communication, I do not think is doing them very well right now. It'd be far better for them to pretend that they knew what they were doing, to admit they don't know what they're doing. My not so humble opinion, apparently. If, and this is a possibility which must be considered, if things do get worse, it's always possible. Not saying they will. If they do, the world and the nations will look erroneously, I believe, but nevertheless they will look once again to their central banks, and they'll dress up their central bankers in the cloth of saviors once again. And if that happens, what exactly do the central bankers do? What do they do? Is there some other policy beyond quantitative easing, which doesn't work anyway? It may have worked somewhat in the beginning. It's extremely less effective as it goes on, diminishing returns to a huge degree. In that case, if we go there, and I'm not saying we will, and I'm not saying that we should, and I'm not hoping that we do, but as a possibility, it must. Negative rates are the same issue. Negative rates make almost no economic sense. On top of that, again, they don't work. The driver of productive investment is productive production. You invest in a plant because you expect to make money at it. We have seen negative rates are simply quantitative easing. They're all the same policy. Cheaper money will get people to spend it. Well, you know what you get? You get a lot of uneconomic investment, which you back to the commodity cycle, back to the deflation forces in the world economy. That's what you get when the primary resource of a capitalist world is mispriced. Capital. When you don't have a rational, sensible price for capital, then all of the economic and business calculations based on that are not accurate. Okay, so that's the last issue. If we end up where there is a recurrence of the type, if not the degree, of concern and fear that took place in 2008. And remember, there's plenty of debt out there. There's plenty of stuff to worry about. Then you will get, I'm convinced, a fear trade to the dollar. So, in summary, I believe we have a continuing positive aspect for the dollar in the various commodity and emerging market currencies. I think we do not have that trend possible in the majors, but there is lurking behind this, I believe, the possibility, and I think the possibility is actually growing as time goes on, that this recovery is going to be hard to sustain, even in its rather limited form so far. Capitalism as a system needs to weed out the dead wood. That's what recessions are for. It's now, the recession ended in June 2009, 10, 11, 12, 13, 14, 15. That's 6 years. The longer it goes on, the closer we get. Now, this is also an oxymoron, not really an oxymoron, but it's just true on the face of it. the closer we get to the next recession. And that is something which I think the world is not in very good shape for. So, on that positive note, I will let you all go. I thank you very much. I've noticed that almost everyone stayed. I apologize for the initial faux pas in getting started. The thing I didn't answer, China will not Japan. I do not think China will be like Japan. I think China is a far more dynamic economy right now, and still has huge numbers of people demanding success. So I don't think you're going to get the same type of a 20, 30 year basically flatlining economy that you've seen in China and Japan. Okay, thank you very much, everyone. My name is Joseph Trevisani. I am the Chief Market Strategist at Worldwide Markets. I will type in my email address. Anyone who is interested, please send me an email about any topic you'd like, including Walt Whitman, and I will be glad to. I was listening to on the way in. I was listening to a Lana Del Rey song this morning, and almost the entire lyrics are "I sing the body electric," which was kind of surprising. I'd never heard that one before. And I'll be glad to talk to you and discuss anything that's on your mind. Again, thank you very much for listening. I take it as a great compliment that people take time out of their day to hear what I have to say. And I do think that the next one we will do, which will be next month, which is only a couple of days away, will be on Japan. And if it's on Japan, it must be on China as well. Okay, thank you all very much for attending, and I hope you all have a very good day. Take care.